properly. And also, some of the tutors were kind of busy. So this person is a volunteer, and this person would see it as a way of sacrifice. So to be available to ensure that materials that are needed are sent earlier. Though we will need to send a compiled or a composition of materials so that if there's adjustments, the tutor will just adjust it and just send ahead of the class. So these two volunteers are there to just follow up on classes and whatsoever that is needed for the class. So I don't know if there's any volunteer like that, please let us know. So thank you so much for that. What else? So we have more than these numbers. Let me just hold on. Miriam, so you are volunteering, right? So we have Miriam, then we have
Yes, sir.
Boluwatife. Oh, fantastic. So Miriam, I saw your hand up first. So Miriam, the class governor, then Boluwatife, I believe you are volunteering as well. So you too, the assistant
Yes, sir.
governor. Thank you so much. So you guys work together. So if one person is not available, the other person will also be available. So you can reach out to tutors, reach out for materials. So just ensure that whatsoever that's needed for the class and also if there are opportunities like spare time, so just let me know so that we can plan the class ahead if the other students are also available for that particular time. And the reason why we do this is because the syllabus is bulky, the syllabus is complex, and the online platform, although it has an advantage, but also has a form of restriction whereby there's a limit to how you can quickly explain in-depthly for students to understand. So we may not be able to cover up the complex syllabus if we are not committed to time. That's why anytime that is available, just want to just take advantage of that. Group accounts is always treated on Saturdays, while standard is treated on Sundays. And the time allocated for group is 3 hours, while that for standard is 2 hours 30 minutes. So you can see that there is the time for group itself is even an indicator that group is something that requires time because it's kind of complex. So the class governor will help us to. Someone is not muted. I can hear myself. Please let's check our mic and mute. So as I was saying, the class governor will help us to organize that. So though it may not be now, but during the course of the class, when there are times whereby there's free time and the students are also available, so you can just quickly do something. And also if you have questions, please share on the group platform. That will be beneficial for the whole class. Let's share that on the group platform. It will benefit everyone on the platform. It will benefit everyone on the platform. So, all right. This is 2:25 already. I believe, and now majority would have joined the class. Still having lesser people here. Still having lesser people. Oh, okay. So let's start introduction to group account. So let's just say a word of prayer. Father, in Jesus' name, Lord, we thank you for today. We pray that you give us wisdom, you give us understanding as we venture into today's lecture. And we pray that in the course of this group account, you give us the wisdom the strength, the grace to understand whatsoever that is needed, and to understand whatsoever that is required for the success of this paper. Thank you, Father. In Jesus' name we pray. Amen.
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 Amen. All right. Okay,
Amen.
so
Amen.
let's start. Let's start. Please give me one 10 seconds, please. 10 seconds. Okay, quickly. Welcome everyone on board again. So let's just have an interactive section for just 4 minutes. So from 2 to 3 people, is there anyone that wants to tell us their understanding of group accounts? When you hear group accounts, what do you understand? Please, I'll only take those that put up their hands. All right, I'm seeing the first person, Bisola. So Bisola, please, you can speak. What do you
Hi,
understand
good
by group
afternoon.
account? Good afternoon,
Okay,
ma'am.
group accounts is when you're accounting for a company that has holdings like more than one or two companies together. For example, you have a parent and a subsidiary. So that's it.
Fantastic. Fantastic. Thank you so much, Bisola. Fantastic. Dixon, I want to try, sir. Okay,
Yeah.
I'm with you, ma'am. Um, yeah, you can speak, please. Miriam, you can hear me, please. Unmute and speak.
Okay. Okay, sir. Group
Right.
account is the combination of financial results of a parent company and each subsidiary into a single set of financial reports.
Fantastic. Okay, thank you all for the contribution. Fantastic. So um from what I've had so far, I can hear parent company and subsidiary. I'm very sure that majority of us here will be like wondering what does a parent company mean? What does a subsidiary mean? So when we say group accounts, when we say group accounts, it is nothing complex. Group account is simply the account of a parent company and its subsidiary prepared and presented as if they are what? They are a single economic entity. What do I mean? It means that you bring the separate financial statements of the parent company, consolidate it together with that of a subsidiary company. The end result give us a what? A consolidated or a group financial statement. So who can tell us what are the elements of a financial statement?
Sir, please,
If
someone is
somebody is
unmuted.
so who can tell us the elements of a financial statement? The elements of a financial statement. I believe at this level should know what the elements of a financial statement are.
Dixon, please, can you mute?
Anybody that wants to tell us?
I'm not the
Okay,
one, sorry.
let's see.
Okay, so we have statement of financial position.
Yes, please, you can speak.
Can you hear me?
I can hear you, but your voice is low, very low.
Yeah, I said we have statement of financial position.
I want to say you are speaking, but your voice is kind of very low. And you said statement of financial position, if I'm not mistaken.
Yes, yes.
Okay,
Then statement of changes in equity,
all right.
statement of profit or loss and comprehensive.
Okay, thank you so much, Omotoyosi, for contributing. Thank you so much. I'm struggling to hear you. Thank you so much. Nathaniel, want to say something contrary to what Toyosi has said?
Yes, sir. Good afternoon, sir.
Okay, good afternoon, sir.
We have assets, liability, equity.
Okay,
That's all.
all
Income
right.
and expenses.
Fantastic. Thank you, Nathaniel. Thank you. Thank you, Omotoyosi. Omotoyosi actually um, missed the components, the component of financial statements with elements of a financial statement, right? So let's be careful when we are being asked the elements or the components so we don't take them for each other. Simply put, the elements of a financial statement are those items that forms the components of a financial statement. And the elements of a financial statement are five, while the components of a financial statement are also five. Assets, liability, and equity are elements of a financial statement that is being used to prepare our statement of financial position, while income and expense are used to prepare statement of profit or loss. So the component of a financial statement are statements. So for those that does not understand abbreviation, let me write it in full so you get to know it later on. Statements of financial position, statement of profit or loss, another comprehensive income, then statement of changes in equity. I believe I've started recording by the grace of God. Statements of cash flows, then notes to the financial, or let me just say notes to the account. Are we following? Notes to the account. So let me quickly confirm that I'm recording, of which I know I'm recording. Yeah, I'm recording.
So you are recording.
All right, thank you. So those are the components of financial statement. Now, how does that has to do with the group accounts we were explaining earlier? It has to do with group Abdulbasit. You have something to say? Please speak.
No, sir, go on, go on.
Okay, hands are up, that's right. So, how does this has to do with group account? Remember, we said that a group account is the account of the parent company and its subsidiary prepared and presented as if they are what? They're a single economic entity. Meaning that the separate financial statements of the parent company and the separate financial statement of the subsidiary company, add them together we have what? A consolidated financial statement. And what are those financial statements we are referring to? Those financial statements are the components of the financial statements, meaning the statement of financial position, statement of profit or loss, statement of changes in equity, statement of cash flow, and notes to those financial statements. Are we getting it? So those are the financial statements where joined together becomes a what? A consolidated financial statement. Let's come back to the material. Now, when it has to do with group accounts, there are ways of accounting for our investments. So let me start with that first. There are ways. Okay, let me not start with that first. Let me start with the definition of a parent company itself. So when we say a parent company is simply an entity, and sometimes we call them an investor. So simply an entity that controls, mark the word controls, or control, that controls one or more entities. That's the parent company. And in the concept of group accounts, control will occur when that entity acquires above 50% of the what? Of the equity shares of another entity. Take for instance, GTB PLC decides to acquire 50% of the equity share of FCMB Bank. GTB PLC will be seen to what? To have acquired control over what? Over FCMB. That's what it means. Because they acquire what? Above 50% of their equity share. In that case, GTB PLC is the what? Is the parent company. Is a parent company. And sometimes they call them holding company. HO, holding company. Call them holding company. But now FCMB in that situation will be seen as the what? As a subsidiary. Will be seen as a subsidiary. Now, what is now a subsidiary? A subsidiary is an entity that is controlled by another entity. Mark the word controlled as well. An entity that is controlled by another entity. That is what? A subsidiary. As a subsidiary. All right. Now, what is control that we are now referring to? What is that control that we are referring to? So, control exists, or control means that an investor have rights or is exposed to what? To the variable returns. So, it means that an investor has rights or is being exposed to the variable returns from their involvement with what? With the investee. So they have rights or they are exposed to the what? To the variable returns with their involvement with that what? With that investee. And they have what? They have the ability to affect those returns through its power over the investee. Through its power over the investee. And when we say power in this case, power means they have the what? The current ability. They have the current ability to direct the relevant activity of the investee. Are we following? I have a question at this point. Please, what are the relevant activity of an organization? Can anyone help us out with that? Please signify by raising up your hands. Diana, you have the floor, please.
The relevant activities of an entity is investment, financing, and operation.
Fantastic. 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 I'm so impressed with that. Thank you, Diana, for that. So, others can put your hands down. Thank you so much. Diana has just nailed it. So, the relevant activities of an organization is not usually more than these three: the investing activities or investing decisions, the financing activities, and the operational what activities. And the operational activities. So, if an entity now has the current ability to direct that what those relevant activity, then that entity is said to what to have control, or is said to have power over that what over that entity. That's what it means. So, and that's why we said mad work control. So a parent company, in paraphrasing now or rephrasing that statement, a parent company is an entity that has the current ability to what to direct the relevant activity of the subsidiary. Do you get that? Do we get that? So let's understand those words, those keywords. Now,
Sorry, sir. Please
remember
ask a
we said
question.
that. Hold on. Really one. You said you have a question.
Yes, that depends company that you just explained. Is it must have 50% or more than 50% of the share equity of the other
More
company?
than 50, more than 50%, please.
Okay,
Above
I have a
50%.
follow-up question to that. What about if let's assume that three company comes together and one company has 50% and the other has maybe let's say 30 and 20. Can that company that have 50% still be considered the parent company of those two, since they have lesser shares than the other company that has 50%?
Exactly. They will be considered as a parent company. And since we are just starting, we have still explained some few things, and that your question will be perfectly answered and you get clarification. Is that fine?
Okay,
Udon?
sir. Yes,
All
sir.
right,
Thank you,
thank
sir.
you. You're welcome. Stella. Okay.
That was an error, sir.
Okay, thank you. So, I was about to say something. I said, now, remember I said above 50% of the equity share. What now happens if an entity acquires below 50%? So, if an entity acquires 20%, when they acquires 20% and above, but below 50%, what then do we now say happens? Because once they acquire more than 50%, we say there is what? Control. There's control. But what if they now acquires more than 20% but below 50%? What can we say then? In this kind of situation, there is what is known as what? Significant influence. Significant influence. Once there is significant influence, it means that that entity has the power to what? To only participate and not control. So they have the power to participate in the financial and operating policy decision of what? Of the investee, but not control, neither is it joint control over those policies. What do we mean? It means that yes, so you can participate if they are making decisions in the AGM annual general meeting. If they are bringing suggestions and making decisions, you can participate. You can bring your own thoughts, but however, your thoughts, your participation, your suggestion is based on what? On the approval of those that has control. That is, if your suggestion can either be accepted or not. So in that case, since you can participate, it means that you have significant influence, but you don't have control. You don't have control. Your suggestions, your participation can only be accepted by those that has control. And now in this case, it means that if, for instance, Dangote Group, acquires 35% of the percentage holding of, let's say, let me just use a random name, let's say Binta Oil and Gas. So if Dangote Group should acquire 35% of Binta Oil and Gas shares, who is Dangote? Who is Binta Oil and Gas what to Dangote? And these 35% shares that they acquire, what does it represent in a group structure? Please take note that Dangote Group is seen to be the what? The investor. Is seen to be the what? The investor. And this 35% they acquire gives them significant influence in what? In Binta Oil and Gas. It gives them significant influence over what? Binta Oil and Gas. Who then is Binta Oil and Gas to what? To Dangote Group. Binta Oil and Gas is what? Is an associate. It's an associate of what? Of Dangote Group. Please, do we get it? The question
No,
then
sir.
lies that no, you don't get it. All right, let me explain that again. Let me take you that again. If now, remember we said that, let me do that on a clean sheet. Remember we said that if an investor acquires, let's say 75% of the equity share of an investee, who is this investor? So who is this investor in this kind of situation? Who is what this 75%? What does it guarantee? And this investee, who is the investee to what? To the investor? That's the question. The investor in this case is what? Is the parent company. Why? Because they acquired 75% of the equity share, or let me just say they acquire more than 50% of the equity share of the investee, thereby acquiring what? Acquiring control over the what? Over the investee. So this investor now has control over this investee, right? Good. Now this investee, how do we refer to this investee to the investor, or how will the investor introduce this investee to other people? It therefore means that this investee is what? Is the subsidiary of the investor. They are the subsidiary of the investor because they are being controlled. They are an entity that is being controlled by another entity, which is what? The parent company. Do we get this part? Let's now take
Yes, sir.
another illustration. Let's now say the investor acquires 35% of the equity share of an investee. Who then is the investor? Who then is the investee to the investor? Then who then is what then is this 75% guaranteeing to the what? To the investor. That's not the question. Now, take note that this investor here will be seen as not the parent company. We won't call them parent company in this case. We won't call them parent company. You will only call them parent company if they have other percentage holding in another company, thereby they have control. Because from the definition, line with what? Line with IFRS 10, a parent company is an entity that controls one or more entities. There must be control before you can see them as what? As what? As a parent company. So yeah, we can still refer to them as an investor or as an investing company. So they are an investor. But this their percentage holding in a company, what does it guarantee? This percentage holding gives them what? Significant influence. Gives them significant influence over the what? Over the investee. So they have significant influence because they acquire above 20% but below 50%, meaning that they have the rights to participate in the what? In the financial and operating decision of the what? Of the company. But they don't have what? Control. Neither did they have joint control over those what? The affairs of those companies. So this investor has significant influence. If this is true, then who then is the investee? So the what? Investor. If the investor want to tell other people about their investment in this entity, what would they say that investment is? Now, they will call this investee their what? Their associates. They will call them their associates. So they are not subsidiaries. They will be referred to as what? Associates of this what? Of this investor, because they have significant influence over this what? This entity. Is that fine? Do we get it clear now?
Yes, sir.
Yes, sir.
Fantastic.
Yes, sir.
So, Aziz, you have a question for me,
Yeah.
sir?
Yes,
Thanks, sir.
please. Can you please take this associate part again, please?
From the beginning.
No, just the associate part. I understand it till after the significant influence, but how this investor is related to the investee, like in terms of the associates.
Okay, so that means, okay, let's say this investor is let me use a company, like a company that has subordinates. Who knows where about Asian Microfinance Bank? So let's assume this Asian Microfinance Bank acquires 40% of, let's use another microfinance bank for example. Let's say let me just say random ABC Microfinance Bank. If they acquire shares in ABC Microfinance Bank, and the totality of their shares sum up to be what? To be 40%, because ABC is assumed to be what? To be full 100%. So out of this 100% of their equity share, these people acquired 40%. Now, to Asian Microfinance Bank, in their books of accounts, how do they report this their 40% holding in ABC Microfinance Bank? What would they classify it as? They won't say investment. They won't just call it investment. They will call it what? Investment in associates. Do you get it? So meaning that this ABC Microfinance Bank is their associate. Say meaning that also that they have an investment in associates. They have an investment in ABC Microfinance Bank. That's what it means. So when you get the financial statement of Asian Microfinance Bank and you are not seeing investment in associates. So when you see investment in associates, in front of it, they now put the name of the bank, ABC Microfinance Bank. So it means that you cannot say that, oh, ABC Microfinance Bank is an associate of Action Microfinance Bank. That's what it means. Do you get that, sir?
Yes, yes, I get. Thank you.
You're welcome, sir. Ellen, you have a question?
Yes, sir. Good afternoon. From your explanation,
Yes.
can you hear me? Yeah.
I can
It
hear you.
simply means that the share percentage determines if one is an associate or investor in a company.
No, it determines if that other company, if you have control over that company or not. That's what it means. The question is that company, who is that company to you? That's what we are trying to explain here. Who is that company to you? That company that you acquired as shares, how will you call them to you in accounting terms or in group accounting terms? Do you get it, Ellen?
Yes, sir.
Right. Good. So that means an associate is an entity, can you see, an entity over which an investor has significant influence, and which is neither a subsidiary, so they are not subsidiary, nor an interest in what, in joint venture. You will get it. So that's the definition of an associate. That's the definition of an associate. So okay, let me quickly now explain. There are ways to other things. No, we've explained 40%. There are different ways an investor can account for their what, investments. So an investor can decide to make investments in companies. Remember the time Fidelity Bank, I think most banks sold some of their shares last year. Yes, last year. So Fidelity Bank was part of them, GT Bank. So they were selling shares. So they're selling shares. People are subscribing and purchasing some of the shares. Now, if an investor wants to invest in companies, want to acquire their shares, and they do so, they acquire their shares, how will they account for that, their investment? Or what are the types of investments we have? The types of investment and accounting for those investments. Now take note. When an investor acquires above 50% of what, of the equity share of an investee, when an investor acquires above 50% shares of an investee, that kind of investment makes this investor a parent company or a holding company, makes them a parent company or holding company, and it gives them what, control. This 50%, this above 50% gives the investor control over that investee. That investee will be seen to be the what, the subsidiary of that investor. So that investor will be calling that investee their what, their subsidiary. Let's take for instance the case of husband and wife. Once the husband marries the wife, in this case the husband is the parent company, the wife is the subsidiary. So the husband will be calling the wife the subsidiary, while the subsidiary, which is the wife, will be calling the husband my parent company. That's how it is. The way the husband calls his wife wife, the woman wife, while the woman calls the husband and the man wife, husband. Same thing that applies here. Once there is control, the guy will be seen as the parent company, the other person to the guy will be seen as what? The subsidiary of this person. Now, how do we account for this? Which standards apply in accounting for this investment in subsidiary? Now, we cannot call it investment in subsidiary. Which standard applies? The standard that applies is what? Both IFRS 5, IFRS 10 and IFRS 3, because two of them are directly handy, so they go hand in hand. We'll still explain the standard. So IFRS 10 and IFRS 3 are the two standards that will guide us in accounting for our investment in subsidiaries. Do we get that? That's for that. On the other hand, if an investor acquires 20% or above 20% or below 50%, so that is from 20% and above. Let me put it this way, so for better understanding. Let me say acquires 20% to 49% of another company. What then does this percentage guarantees the investor? What does it guarantee the investor? Now, because it is 20% but below 50%, please hold on. So are we following? So who then is the investor? What does that percentage guarantees the investor in this case? That percentage guarantees the investor what is known as what? Significant influence. It guarantees them significant influence. Right? Because they don't have control. They only have the power to participate, but they don't have control, neither joint control over their what? Their participation. So they have significant influence. How do we then now call that investment? So then, what's the investment or that entity? What will it refer to? It will refer to as what? As an associate. Associate. Let's take the case of two people now, two entities, entity A and entity B. Entity A and entity B. If it's this guy that acquires the shares of this B, 40%, then A is the what? Investor. B is the what? Is the associate. B is the associate. So this investor has significant influence. Therefore, this investor can say they have what? Investments in associates. They can report in their book and say they have investments in associates. So you cannot conclude and say, oh, this B is an associate of A. That's how it works. But the A will say that they have investments in associates. So we'll call the B an associate of A. So when we have an associate, when there's investments in associates, which standards apply? Which standard apply? That's the next question. The standard that applies in this case is in line with what? IAS 28. So IAS 28 is what gives us what? Accounting guidelines, principle on how to account for our investment in associates. How to account for investment in associates. IAS 28. So see, I explain each of the standard in depthly. Then, if an investor acquires zero, let me know 0%, because it will prompt other questions. If they acquires, we can still use zero. Consider zero, but let me start from 1. Let me start from 1. 1 to what? 19%. When they acquire 1 to 19%, what will that investor have? What would they call that their investment? The investor does not have control. Neither did they have significant influence. Neither did they have what? Joint control. So in this kind of situation, they call this investment, they only have a minor investment or a simple investment. So they only call this a minor or a simple investment. Let me put it there. Minor or simple, minor or simple or ordinary investment. So that means in their books, they'll just put investments. They'll put just investments in their books of accounts because they don't have interest in control. They don't have interest to have influence over that company. They don't have interest to have joint control over an arrangement or a company. They only just want to make investment and have what? Returns on their investment. So in that case, they will only acquire 1 to what? 19%. That gives them what? Makes that entity just a minor or simple ordinary investment. So investor will just have a simple investment or minor investment. They can decide to have that. So how then do we account for this kind of investments? We account for it with the provision of IFRS 9, financial instruments. Financial instruments. Are we clear on that? Ife, please ask me a question.
Okay, so I'm just trying to put into context. Can we liken this to the shares that we buy that individuals buy from all these companies?
Yes, definitely. Do you get? So it's just that individuals does not have the financial capacity. Although if the individual is influential and the likes, they do, but in a real sense, most individuals does not have that financial capacity to actually purchase, to actually use that, to have that huge sum of money to purchase it. And that's why I see some of these companies, they have people that actually have that money. There are some people that actually have that money. For instance, take the case of Dangote. The Dangote group, obviously, and it's very obvious, this Aliko Dangote is the major shareholder of that company. So that makes him the will I say the head of that Dangote group as a whole. As a whole. Do we get it? Although there are other shareholders, so we should not confuse, there are other shareholders, but he still has control. He's the one that can still say do this. But however, Nigeria cases, there may be people that are still on the ground, that is just him can just be like a figurehead, whereby the main people may be on the ground using their money to just, maybe they don't want to be seen, they just want to be in the cover. Do we get?
Thank
You're welcome. Josephine.
Good afternoon, ma.
That is sir.
Yes, ma. Please, ma, in the case of this 19%, what would the investee be referred to as?
Okay, the investee. Please, I think you're asking for the guys because I can hear my hand. So the investee will just be referred to as a normal investing company. So the investee is not, you don't call the investee anything to the investor. So you just see it as a normal company. You can't say the investor will only call them that they will say that they have simple investment or they have investments in that company. But to that investee and to that investor, that company is just an investment company whereby the investor choose to what, invest and earn return on their investment. You get, so that other investee, you don't have a particular name you can say they are to the what, to the investor. So they are just there. The investor just have simple investment. They just want to invest their funds. They don't want to keep their funds idle. They just decide to let me invest and just have a return on my investments. Do you get? Do you understand that, man? Peace, you have a question?
Yes, sir. Sir, you've been mentioning 49% and above 50%. What happens when it's sir? What happens when it's 50? Yeah, 50%.
Exactly, peace. We are coming there. Thank you so much. All right, so I believe we all understand up to this point. Yeah, so now peace brought our attention to something. He said that we have been mentioning above 50%, 20% to 49%, 1 to 90%. What then happens to the 50%, exactly 50%? What then happens? Now, take note that is what is known as what? Joint arrangement. Joint arrangement. Joint arrangement. This joint arrangement is a form of arrangement where two or more people gather together to jointly share control. To jointly share control. That's a joint arrangement. And this kind of joint arrangements can either be joint venture, joint operation, let me start with that. Can either be joint operation or joint venture. Now, in view of this, we can't say that we can't attach a particular figure to it. Although in the last diet, we say that once it's 50%, once they acquire 50%, then there is what? Joint control. Or there is joint arrangement when it's 50%. The reason why I don't want to attach figure to it this time is because that last time I just to avoid complications. But now, to get it more clear, it can be 50%, like 50-50. It can be 30-30-30 within 3 people, or 33 plus. So everything should be 100. Everything should be 100. Because when we say joint arrangement, it's a form of arrangement where A and B, or A, B and C, or A, B, C, D, they come together to what? To jointly share control over an arrangement or over an entity. So meaning that the two of them can try to come together that let's have joint control over this company. You acquire 50%, I also acquire 50% of this particular company. So in that case, we have what? Joint control. It can be 3 of us, 33 and a half, or 33 point something, 30 point something, 30 point something. We jointly what? Share control. It can be 4, 25, 25, 25, 25. We jointly share control. And that's why I don't want to attach 50% to it, because it may be more than 2 people that is jointly sharing control. So it is only 50% if it's just 2 people that are sharing control. Do we get? So that's why I don't want to attach people. So someone asked a question too, that is there a situation whereby they can be what? Someone can acquire 50%. a single individual can acquire 50% of a particular entity. It's not more than 50%, just 50%. And I think someone asked that question this today as well earlier, that I said we'll get there. What happens in a situation whereby it is not that two people come together to jointly share control, but as people are acquiring shares, they discover that someone acquired 50%, someone acquired 50%, and it's not more than 50%. Can we now say that that person has control or not? How can we tell that that person has control or not? Please, let's pay attention. It should be noted that before the advent of IFRS 10, when we still have IS 27, because IS 27 then was the separate and consolidated financial statements. Before, when you acquire above 50%, that's when we can say control exists. Control exists. But now, once you acquire above 50%, we cannot decide whether control exists just like that. We need to look at what is known as what? Substance over just the substance over form. So we need to look at the substance over just what the mere transaction, or just the mere legal transaction in that case. We need to look above the substance. We need to look at the substance rather over just the mere form of it, because there are sometimes you can acquire 30%, but you have control. And that's the case. A very good case is the case of Dangote. Dangote may not acquire up to 30, may not even have up to 50% of the total equity holdings of the Dangote group, but he has control, because it is not just about the mere form of that transaction, but the substance. Are we getting it? Just the substance. But in the case of this exam, control is usually assumed when there's what, more than 50% for the case of this group account. But in reality, there are many factors that we consider before we can decide that control exists. Let me quickly use that opportunity to touch that. Let me use that opportunity to say that. So, situations where control exists. So, this matter said the definition of control is quite complicated. The following are the possible situations where control is seen to exist. So, now we said in practice, the vast majority of cases involve a company achieving control of another company through what? Through buying a controlling interest in its what? In its shares. In vast majority of cases, obtaining controlling interest means buying shares which give the holder more than what? More than 50% of the voting rights in the other company. When you buy shares, and that shares give you more than 50% voting rights in the other companies, you have what? You have control. But however, control is assumed to exist when the parent company owns directly or indirectly through other subsidiaries more than what? More than half of the voting power of the what? Of the entity, except or unless in exceptional circumstances where it can be clearly demonstrated that such control does not exist. What are we saying? We are saying that whenever you have more than half of the voting rights, meaning that when you come to the AGM meeting of a company and you have more than what? More than half of the voting right of the total shareholders or total board of directors of that company, then you have control. Because when you make a decision, you have people that will support you. You have more than half of the people that support you. So if you said let's do A and someone say let's do B, it is very certain that when they cast a vote, you will definitely win, because you have other people that you can control. We have people in the board of directors that your final say is what they listen to. So you would have communicated to them that this is your own decision, and they will follow and vote for you. Definitely, the majority will carry the vote. So if you have more than half of the voting rights, it means you have control whether or not you acquire up to more than 50% of the equity share, and that's where the substance over form accounting this thing come into play. Are we following? So in a situation whereby somebody acquire 50% exactly, it means that control may also exist. So we need to check more than just the mere legal form and look at the substance. So, but for the purpose of this exam, the examiner will not make it complex. It is either above 50% or below 50%, nothing more. Are we following?
Yes, sir. Thank you, sir.
You're welcome.
Sir.
Onwani.
Okay, good afternoon, sir.
Good afternoon, boss.
Yeah, please, on this joint arrangement, I want to
Yes.
ask a question. Is everything just subjected to just the percentage you have? Like, let's say, for example, if I decide to come into business with you and we
Yeah.
agree, and I don't have that, we agree on the 75-25 agreement. Does that insinuate that you are still having control more than me if we come together and say, okay, this is what we want to do? Does that, how will I put it, the percentage, is it relevant?
Yes, okay. I quite understand. The percentage will not be relevant. Let me just say that. Because we need to just look at key terms. Key terms. Because in that kind of situation, it may just be a what? A partnership business. Maybe a partnership and not what? Not joint arrangement. We need to check the joint arrangement we are seeing about is what? When some people come together to what? To jointly share control. Jointly share control. There must be joint agreement, joint control, meaning that the two of you must have the same base, the same basis. You must be having the same say. So it means that if we have A, we have B, we have C. A and B come together to jointly share control over C. You agree with me that this C is also a company. They have what? They have board of directors. That board of directors. You as well, you're a company. A company. So these two people can decide to what? To jointly share control over the affairs of C. Over the affairs of C. Meaning that their word or what they say, they would have met together to discuss that when we are coming for this meeting, no, this is what we want to happen, this is what we want to happen. So when they meet together, when they come to the board, they already have the finances. So you just see that the two of them will just be having the same objective, the same say, because they jointly share control. Jointly share control. But in a situation whereby somebody comes together and one does not have the financial capacity, but two of them agrees together, that kind of formation can just be what? A mere partnership business. Because we have different form of business organization. So it can just be a mere form of partnership business. You will contribute your capital, me I'll contribute my what expertise, someone else can just contribute their good name, just their name. They are not contributing anything else, their name, and the business is going. So that kind of business is what? Is a form of partnership business. I don't know, does that answer the question, sir?
Yes, it's fine. Thank you very much.
You're welcome, sir. Okay, so where were we? Dixon, you have a question for me?
Yes, sir. Good afternoon, sir. Please, I would like you to throw more light on point 3, where we have situation where control exists from the handouts. Yeah.
Okay.
Thank you.
Point 3. Point 3 says that in certain circumstances, a company might control another company, even if it owns shares which give it what less than half, less than half of the voting rights. Such a company is said to have a de facto control over the what other company. The de facto control is a phrase which is translated as it is used to mean equality rather than position held in, if not by what legal right. Now, what that simply means is that, let me use an illustration. That simply means is that, let's say we have a company, we have A, we have B, we have C, we have D. We have D. Let's say each of these companies, they acquired shares in E. Each of these companies has shares in what? In E. Let's say A acquires 40%. Don't forget, this is what? 100%. A acquires 40%, B acquires 20%, C acquires, let's say 15%. So 60, 75, 35, 15. Okay, let me see. This is 25%. 25%, 15%. That's 40. This is 20%, right? So total makes it what? 100%. Now, this 40%, although it is not more or up to what? It is not more than 50%. Or it does not have more than what? More than half of the voting right of shares, but actually controls because his own shares alone is more than the shares of everybody else put together. Do you get it? That's what we call it de facto right. So it means that because there are various individual companies that has shares in a particular company. This is just like an illustration. So one person may have shares of maybe 25%, but that is not 25% shares is more than the shares of everybody put together. For instance, when Fidelity was selling their shares, you agree that a lot of majority of people subscribe for it. A lot of people, a lot. So if one person has 20%, then every other person is now having few percent, 1%, 2%, 3%, 4%, 20%, provided that he has just 20%, but the shares of everybody put together is not up to his own shares that is acquired. That case, he has what? De facto control. He has control. Although it's not more than 50%, but because he has a shares more than everyone put together. So that is what that point 3 is saying. Do you get?
Yes, sir. Thank you.
Welcome.
Sorry, sir. Please, can you please take the number 3 again?
Please, sir, can you please take it again, sir?
All right. Okay. So we are saying that sometimes another entity can have control, even though if it's what? If it owns shares which give it what? Less than half of the what? Of the voting right. More than half of the voting right. Now, please, what you should capture in mind is that when we say voting rights, we are usually saying the percentage holding. That's what we are usually saying in most cases. Percentage holding. The percentage holding. So I'm saying that a company can actually have control over another company if it's what? If it's have shares that gives it what? Less than half of the what? Of the voting rights. So less than half of less than 100%. No, let me not 100%. Less than 50%. That's what I'm saying. If you have shares that is what less than 50%, but so what? You still have control. You still have control because you are in a position. You are in a position that the shares you have alone is more than the shares that every other person put together. Do you get? So it means that you acquire 20% of a particular company shares. You acquire 20%. So we still have 80% shares. Now, only you acquire 80%, 20%, but the other 80% was being acquired by what? By other companies or by other people. So, and let's say for instance, let me make it more clear. This same illustration, let's say the total board of directors of this person, of this company is 20 members. We have 20 members. Now, because A has 40%, A has, let's say, half is 10. Half of the what? Voting right is 10, right? Let's say he has 5. 5, no, let me not say 5. Let me not make it to be half. Let me say 7. A has 7. Let me do it in a separate. A has 7 members. Let me put members so that we can understand when reading. Members of the board. A has 7. B has 5. C has 2. Then D, what's the residual? This is 12 plus 2, 14. Has 6. So I believe this is up to 20, right? It's up to 20, not below, not more than. So, although this guy does not have the shares he purchased, this does not guarantee him to have what? Half of the what? Members of the board, or more than half. He even have less than half of the what? The voting rights. Less than half of the voting rights. But you agree with me that when they are making decisions, this guy still has what? Still has control, because he has more than what? He has a de facto this thing, because his own shares is more than the shares of everybody put together, making him to have what? A position in the board, although less than half, but still have what? A final say in the what? In the relevant activities of that what? Of that organization. So in this kind of case, a de facto control still exists, because although it does not have more than half of the voting rights, but what it still has control. If they make a decision, 7 will still always have the word final say. 7, because the highest vote has the what? Has the final say. Do we get it?
Yes,
Hello?
sir.
Yes, sir.
Yes,
All
sir.
right.
Quick
Yes,
one,
sir.
Yes,
sir.
sir.
What is the situations where the members from both B, C, and D combined to say, oh, they are making this particular decision? That takes
That
off
is
the de facto on against A.
that is a separate thing entirely, boss. That is a separate thing entirely, and that's where we now know what is known as what? Joint control. That is separate thing entirely. Do you get? So, but for this explanation, for that point 3, this is what it means. So in that kind of case, is a different thing, and you know, in reality, this is theory we are trying to explain, but in reality, there are different things that occur, there are different things that happens. So someone can still go beyond back and say, and so, but that does not mean that this guy does not have control. There's still some cases control is still be guaranteed. Control is still guaranteed, but there are still exceptional cases, because a lot will still be happening. A lot will still be happening. So do you get?
All right.
All right, so we have spent a lot of time explaining that. Okay, so all these standards, one way or the other, Oluwafikemi, your hands are up, so I don't know if you still have a question. I can't see your full name,
Someone
please.
already asked my question.
Oh, okay, okay. Campaign has done that, so all these standards are one way or the other affect the preparation of our group accounts. Like we said, if you have an investment in associates or joint venture, you apply the what principle of IS 28. You are still coming there. If you have control, you apply the principle of IFRS 10, and IFRS 3 also goes in line with IFRS 10. They work hand in hand. So once you acquire control, the principle of IFRS 3 and IFRS 10 comes into play. That
You
is,
don't
you
worry,
invest
definitely.
in subsidiary. Say what? Now, once you jointly share control over an arrangement, and that arrangement is a joint operation whereby you have rights to both the assets and the liabilities that will be assumed in that business. That kind of arrangement is known as what? Joint operation. In that case, you account for it following the principle of IFRS 11, joint arrangements. But however, if the arrangements only give you rights to the net asset, that is, you are not concerned about the liabilities assumed, then you apply the principle of IAS 28. That's why you see here investments in associates and joint ventures. We'll still understand that better. So joint arrangement, I've said that when it's a joint operation. Then we have IFRS 12, disclosure of interest in other entities. It's a standard that helps us to know the necessary disclosure when an entity has interest in other entities. So IFRS 12, then fair value, there's no way you talk about you not make mention of fair value. You always hear fair value, fair value. When you do the standard IFRS 13, you understand better. So all those standards affect our group account one way or the other. We have not done much on time has fly. Okay, so I want to explain something. So when we say once an examiner asks you to prepare group account, this mistake was made in November 2024. The DIE tested group cash flows, and the examiner was so nice, so great that even prepare the cash flow for them. What you are just left is to just consolidate. But students were confused. Most of them were not attempting the question because they don't know what to do. They were dumbfounded. They were not expecting good cash flow. So, and it's very simple because when we say group account, it is account of the what? Parents losses subsidiary. Prepare and present as if they are a single economic entity. What it means is that for a group statement of financial position, because when we say group financial statements, we are simply referring to what? To consolidated, let me say group account or consolidated financial statements. Financial statements is simply your consolidated statement of financial position, that is your group statement of financial position, your consolidated statement of profit or loss, your consolidated statement of changes in equity, your consolidated statement of cash flow. That's all. Then the necessary disclosure in line with IFRS 12. So all this, meaning that for a statement of financial position, we all know what a statement of financial position is. That is so, where we have the assets, liabilities, and what? And equity. Right? Let me just look for a random past question. So it is simply the statement of financial position of the parent company and that of the subsidiary. This is the financial statements. Okay, let me use this as an example. Let's say this is 3 companies, but we are concerned about these 2 first companies. And let's now assume that this one is the parent company, this one is what? Is a subsidiary. This one is a subsidiary. So if we are asked to prepare a group statement of financial position, we agree that this is a statement of financial position because it has the assets, it has the equity, it has the what? The liabilities. So if you ask to prepare consolidated statement of financial position, simple. If you don't even know the process, you don't know any other thing, just consolidate. What it means is that you add the like assets, the like items, that is the assets will be added together. All the assets will be added together. Ignore the investment. So all the assets will be added together, added together. So it will give you what? A consolidated financial position. That's what it means. Then the same thing applies for profit or loss. The component, or rather the element of a statement of profit or loss is what? Is income and expense. It means that you add the income of the parent company with that of the what? Of the subsidiary. You add the expenses of the parent company with that of the subsidiary. What you have is what? Is a consolidated statement of profit or loss. The same thing applies to statement of change in equity and cash flow. The same thing. They prepare the cash flow for you. You just add them together. Although there are other principles, but in a situation where you don't know what to do, but from the definition of what? Of a group account, that alone would have fetched you mark than not attempting the question at all. So do we get that? So these are consolidated accounts that we have. Okay, let's go further. Something came to my mind that I wanted to share. I'll remember later. So there are certain terms we also need to be familiar with, which includes pre-acquisition reserve and post-acquisition reserves. Pre-acquisition reserve is simply, when we even say reserve, working is even there, profits, mean profits. So these are aggregate reserve or profits of the what? Of the subsidiary company before they have been acquired by the parent company. Before they have been acquired by the parent company. So what is the position of the profit of the subsidiary before they have been acquired by the parent company? So that position is known as what? Pre-acquisition reserve or profits. The profits made by the subsidiary company before they have been acquired by the parent company. In that same manner too, we have what is known as post-acquisition reserves or profit. From the word post-acquisition, meaning after acquisition. Meaning after acquisition. So the profits that is being made by the subsidiary company after being acquired by the parent company. After being acquired by the parent company. So we will see all this better. Then the concept of control. So all this is something we carried on our own. So when there is control, when the parent company has control over the subsidiary company, what does that mean? We said that control exists when there is power over the investee and when the parent company is exposed to the rights to the variable returns from investment from its involvement with the university, and they have the ability to use the power to influence the amount of that returns. So what is a power? The definition of power in line with IFRS 10. Then, let's look at this illustration here. We have an illustration. We have King PLC in the center of this this write-up. We have Prince PLC, Queen PLC, Princess, and the likes. And it's various forms of investments that King PLC has in different entities. And we have the percentage of each equity share that has been acquired by King PLC. So yeah, we say that King PLC acquired 100% of Queen PLC. King acquired 51% of Princess PLC, and likewise. So let's explain what kind of investment does King PLC has in in Queen PLC. Random question, random answer, everybody.
Parents and subsidiary relationship.
Parents and subsidiaries.
Or simply
Fully owned subsidiary.
Fully controlled.
Investment
Fully owned subsidiary.
Fantastic. So because they acquired above 50% in Prince PLC. In Prince PLC, what kind of investment is this? More than 50% investment in subsidiary, right? Great.
Yes.
In Princess PLC, likewise.
Partly owned subsidiary.
Okay. In Princess PLC, they also acquired 75%. It's more than 50%. It's also investment in subsidiary. In Grace PLC, they had 40%. What kind of investment is this? Investment
Significant influence.
Significant influence.
Significant
influence.
It's investment in
Associates.
And associates.
because they have significant influence. Right? So here now, I think there's a statement here. They said that all the companies, based on agreements with other investors, King PLC shares control over Grace PLC with other investors. So can we say Grace is investment in associates? From this statement.
It's a joint arrangement.
Fantastic. It is a joint arrangement because there is a statement. If this information was not given, then Grace is an associate of King PLC. But they said that King PLC share controls over Grace PLC with other investors. Therefore, it means that Grace PLC is a joint arrangement of King PLC, meaning that it can either be a joint venture or a joint operation. Do we get that? Now, investment in favor PLC, what kind of investment is that? Associates, fantastic. Investment in Blessing PLC, what kind of investment in that?
Simple investment.
Fantastic. Fantastic.
Ordinary or simple investment.
Investment in Mercy PLC.
Minor or simple investments.
Investment in Mercy PLC.
Partly owned.
Investment. Partly owned.
Fantastic. That is investment in subsidiary. Now, so this joint PLC, let's explain something. There are types of subsidiaries.
Costs.
We have 4 types of subsidiaries. We have fully owned subsidiary, and a fully owned subsidiary is when the parent company acquires the total equity share or the total controlling interest. In this case, there is no existence of the people known as controlling interest non-controlling interest shareholders. So it means that the parent company acquires the total equity share. I usually say this to my students, or I always say it, that the subsidiary company is made up of two people. Dixon, you have a question for me. So I usually say that the subsidiary is usually owned by people.
Hello, sir.
I can hear you.
Sorry to cut you short.
Right.
From that diagram, I can see King PSC acquired 65% of Mercy. And then the arrow also points that Mercy acquired Joy PSC 80%.
That's what I was about
So,
to.
That's what you explained.
okay.
Yeah.
Just be patient, it's getting there.
I'm coming. I don't know what's wrong with my system. Can anyone hear me?
Yes, sir.
Yes, sir.
Yes. Yes, I
My
can hear you.
system just is not. I'm coming. I think it's my phone. Okay, so I usually tell my student that the subsidiary, if people can see my board, right, is writing.
Yes, sir.
The subsidiary is usually owned by two people, by two kind of shareholders. The first one is what? Is the controlling shareholders. Controlling interest shareholders. The controlling interest shareholders. While the other kind of people is what? The non-controlling interest shareholders. Non-controlling. Don't mind my writing. I'm just trying to be fast. I believe you can see my writing clearly. Non-controlling interest shareholders. So these people are regarded to as what? The parent company. The people that has control. Parent company. PC. Why these other people are regarded as what? Non-controlling interest. They have interest, but they don't have what? Control. And in group accounts, we usually refer to them as what? NCI. So we should be familiar with that word. We usually call them NCI. So this kind of subsidiary, there are types of subsidiary whereby it is only the parent company that has control. So meaning one entity acquires the total control of that other entity. So that kind of subsidiary is known as what? Fully owned subsidiary. So meaning that there's no NCI at all. Meaning there's no NCI at all. So that means the subsidiary is only owned by what? By the parent company. So it's only owned by the parent company. That's a fully owned subsidiary. But there are another type of subsidiary which is known as what? Partly owned subsidiary. And for instance, this Queen PLC is a subsidiary, but the type of subsidiary it is what? Is a fully owned subsidiary. It's a fully owned subsidiary because the parent company acquires the total equity share of that company. Are we following? Then, for the other one, we have the partly owned subsidiary. Partly owned subsidiary. This is a kind of subsidiary who is the parent company acquires controlling interest of more than 50%, but less than 100%. But less than 100%. Meaning that there's existence of what? Of non-controlling interest shareholders in that subsidiary. And a good example is the investment in Prince PLC, in Princess PLC. So this is a partly owned subsidiary. although it's a subsidiary, but partly owned. This one too partly owned, partly owned. Are we following? Then the third type of subsidiary is what? Fellow subsidiary. A fellow subsidiary is when two or more subsidiary are controlled by the what? By the same parent companies. So when two or more entity are controlled by the same parent company, then they are referred to as what? Fellow subsidiary. What does that mean? It means from this our right up here, it means that Prince PLC and Queen PLC, they are what? They are fellow subsidiary. So Mercy PLC and Prince PLC and Queen PLC and Princess PLC are what? Are fellow subsidiaries. So they are fellow subsidiary to each other because they are owned and controlled by the same parent company, which is what? King PLC. Do we get that? That's a fellow subsidiary. Then we have the other one, which is known as what? Subsidiary. Subsidiary. A subsidiary is an entity that is a subsidiary to what? To another entity. No, that's not what I put. So a subsidiary is a situation whereby a parent company to a subsidiary is also what? A subsidiary to another company. I take that again. A subsidiary is when its parent company is also a subsidiary to another parent company or to another company. So for me, and I said an entity is treated as a subsidiary of another entity if it is a subsidiary to an entity which is also a subsidiary to another entity. That's English. Let me explain that using this graph. That's not brings us to the case of Joy PLC, Mercy PLC, and King PLC. Now, Mercy PLC is a subsidiary of King PLC. It's a subsidiary of King PLC because King acquires more than 50% of Mercy PLC shares. Joy PLC is a subsidiary to Mercy PLC because Mercy PLC acquires more than what? More than 50% of the equity share of Joy PLC. The question then is, who is Joy PLC to King PLC? Joy PLC is a what? Is a subsidiary of King PLC. Why? Because it is a subsidiary to an entity who is also a subsidiary to another entity. So King PLC will now say that Joy PLC is my what? Subsidiary because they are a subsidiary to a company that is my subsidiary. Do we get that? That is subsidiary. If you understand that, let's just give a thumbs up so that I know that one is cleared. Then lastly, we have what is known as what? Foreign subsidiary. Simply put, a foreign subsidiary is a subsidiary which is what? Located or situated in a country other than the country of the parent company. You get it? So that is the country where the subsidiary is located or situated is different from that of the what? Of the parent company. For instance, this graph now, it says that the relevant note in A says that all companies are based in Nigeria apart from Prince PLC that is based in London. So the parent company is based in Nigeria, but Prince PLC, who is a subsidiary, is based in London, meaning that in this graph, Prince PLC is a subsidiary, right? But is a what? Is a foreign subsidiary. The foreign subsidiary. Are we following? Because they are situated in a country that is different from that of the what? Of the parent company. Now, let me quickly explain this illustration where control may exist in a situation other than what? Other than just the acquisition of more than 50% percentage holding. More than 50% of percentage holding. Now, the first one says that A has 60% equity share of B. We all understand this part. No any additional information attached. A, number 1, number 2, number 3, we all understand that. Number 4, we also understand that there's joint arrangement. But number 5, 6, and 7, there's a different ball game. Let me start from number 5. Number 5 says that A has 75% in the equity share of B. With, they did not stop there, they did not put full stop. They said with 2 members out of what? Out of 5 directors of B. Although, please follow, although A has 75%, normally we should have said that there's control and B is the what? Subsidiary of A. But the examiner was not, the examiner did not put full stop. The examiner still gave some clause by saying that they have what? 2 members out of the 5 directors. So therefore, in this kind of situation, we cannot just conclude that control exists. We need to look beyond the mere form and look at what? At the substance, which is this other information. Now, 2 out of 5, what does that guarantee us? 2 over 5 times 100, how many percent would that give us?
%40.
40%. Ladies and gentlemen, what kind of investment is 40%?
Significant.
Investment in associates.
Investment in associates.
Fantastic. So it means that this illustration 5, A is an investor, B is what? Is the associate of A, although A has 75%. Can we see it? Do we understand that? Because of this clause, we look beyond the legal form or other form and look at the substance. The substance is the reality here. The reality. 2 members out of 5 means that you don't have control. You only have significant influence because there's still 3 other more that may decide to go against you. The next one says that 60% of the equity share with no member or representative in the board of directors of B. No member at all. So you don't have any member. What does that mean?
No control.
No control. Neither do you have significant influence?
No.
Fantastic. So what kind of investment is that? What kind of investment is that?
Partly.
It's a simple investment.
Simple ordinary investment.
Simple investment.
Minor investment.
Fantastic. Biola, you have a question?
Yes, sir. Thank you. Is it possible to have 60% of equity share and not have any member, any representative in the board of direction in reality?
In reality, may not be so. And in reality, can also be so. Because there are some companies like that, they are not just concerned, they are not bothered about how you run your company, how the activities, how the financing activities, investing activities, everything is being run. They are not concerned. They are only concerned about their money, their returns on investment. As long as they are getting their returns on investment, then they are not bothered. So in a way, in reality sense, it may not be true. And in another way, it can be true. It's based on individual's perspective. So some people are there just let me be getting, they don't want to pass through the stress of, because so some people is stress having board of directors, having to participate in everything, ensure some people is just a stress. They don't want to pass through those process and that stress. So let me just put my money by the end of so time, give me my money back and my interest, or my returns on my investments. Simple. Do you get that, sir?
Yes, thank you.
Welcome, sir. Lekon.
Okay, so I was going to say that I think foreign subsidiaries are like that. If the local economy or the local regulator says that the corporate governance limits the number of board of directors that can come from the parent company, then this can also happen for foreign subsidiaries, actually.
All right. So thank you so much for that addition, that contribution. So Mr. Biola, you have seen that another situation whereby you can no longer the board of directors has gone beyond necessary, so you can't have, so in that kind of case it's possible. So thank you, sir, for that additional contribution. Okay. The last one says that A has 40% of the equity share of B with 3 directors out of 5 directors. With 3 directors out of 5 directors. Although they have 40%, but we need to now look beyond the mere form and look at the substance. 3 out of 5. How many percent is that?
60%.
That although you have 40%, but the 60% guarantee you what? Control. So it means you have control. In that case, B, the investment in B is what? What kind of investment is that?
Partly owned.
That's not the word I want to hear. Investment in what?
Subsidiary.
Associate investments.
Is it associate or subsidiary?
Subsidiary.
No, it's an associate.
It's subsidiary because there's control.
Subsidiary.
There's control. We have more than half of the members of the board, so there is control. So this is an investment in what? In subsidiary. Investment in subsidiary. Are we following? Now, the standard says that whenever there is investment in subsidiary, whenever a parent company acquires control, what do you do? Yes, sir.
Can you please just explain the concept of control so that number, the last point, will be understandable for the whole class, because I think some of the class does not understand.
You understand, sir? I've explained that. I don't want to go back. They understood. So
we understand though.
Has been explained.
No need, sir.
So
excuse me.
Yes, sir. Yes, sir.
Please, I don't understand.
Does it mean that the board of directors are the yardstick for knowing the control? Knowing the control
yes.
The parent has? The board of directors are the yardstick.
The board of directors may not necessarily be the yardstick. If you have been following through the class carefully, I said something from the onset. I said to determine control means that you acquired more than 50% of the voting rights. And this is done by what? Acquiring the shares of the company. Once you acquire more than 50% of the equity shares of the company, you have acquired controlling interest. But sometimes
that's correct.
That may not be the case. That's why I'm not saying that. That IFRS 10 came into play and has make us to ignore that concept. When it was CIS 27, that was the pure basis. Once you acquire more than 60%, automatically you have control. But IFRS 10 is now coming and saying no. We need to look beyond just the mere transaction, the mere form. We need to look at the substance. That substance,
yes, sir.
That substance is not what? It's not the form of the directors, the voting rights you have in that company. You get? So, in that case, control. Please, is there anyone that still does not understand the concept of control? Because of the time. And everything has been explained here. Because when we started in class, I think, yes, that's it here. I said control. When you were exposed to, right, to the variable returns of the investment in the investee, I have the right to affect that what? Those returns. And yeah, we now broke it down here. And that's why I asked everyone to read through this material ahead. We now broke it down here. That what is power itself? Power means you must have the existing rights that gives you the current ability to affect the relevant activities of the investee. And I remember that I asked that what are the relevant activities of an organization? And someone brilliantly answered that and said that the financial activities, investment activities, and operating activities. So once you have the existing rights, that gives you the current ability to direct those activities, then you have what? You have control. So power is a part of control. Power is a part of control. Do you get that? Okay, so let's proceed. Now, as I was saying, whenever there is, please pardon the background noise, the background sound is from my end, please. It's from my end. There is mocks behind, beside me here. So, whenever there is parent and subsidiary relationship, meaning that you acquire more than 50% of the equity share of the company, the standard that applies automatically is what? IFRS 3 and IFRS 10. The standard says that you must prepare what? Consolidated financial statements. Whenever you have subsidiaries, you must prepare consolidated financial statement. That is, you must prepare group accounts. But however, there are some exemptions whereby you can have a subsidiary, but you may not prepare a group account. And what are those exemptions? The exemptions is two. One, if the parent company is is an investment entity. Whenever the parent company is an investment entity, then they may choose not to prepare group account. That's an exemption. The question is, who then is an investment entity? That's the question. An investment entity, simply put, is an entity that obtains funds from various investors for the purpose of providing them with what? With investment services. That's the first thing. And the second thing is that their objective or their purpose is to invest those funds for what? For returns through capital acquisition, investment returns, or for both capital acquisition and investment returns. And lastly, they measure their performance in those investments at fair value. So obviously from this, it means that these companies are not interested in whoever the board of directors are. They are not interested. They are just established for investment purposes, to collect money from people, provide them with investment services, and those money, they invest it in somewhere else so that there will be what? Return on investment. So they are what? So they are investors. Do we get that? So all these people are parent company. That's why sometimes when they acquire more than 60% share, they may not be concerned about control. They may not be concerned about the control. That's why someone can acquire more than 60% and does not have control, because the person just wants to make investments, collect funds from different people and invest that funds in your company. Unfortunately, maybe he's the only one that acquires more than 50%, but the person is not even interested in the control. The person is not interested. So an investment entity is exempted from preparing what? Group accounts. Or if the parent company is not an investment entity but meets any of the following criteria. So when ICAN asks you this question, ICAN will only start from this point 2. But for knowledge sake, you may need to know the first one as well. So ICAN will only start their solution from the second point. That's they will start from A here. That's where they will start A, B, C, D. So the second thing is that if the parent company is not an investment entity but meets any of the following criteria, And what are those criteria? The first thing is that the parent company is also a subsidiary. So if they are also a subsidiary, either a fully owned or a partly owned of another entity. So when they are a subsidiary of another entity and the owners or those entitled to vote are in agreement that they should not prepare group accounts, then you may now decide not to prepare it. And this occur in a situation where in a King, Mercy and Joy PLC situation. Mercy in this case now is a parent company to Joy PLC, right? Because Joy PLC is their subsidiary, so they are a parent company. In this case, Mercy PLC is a subsidiary to what? To King PLC also. So Mercy PLC is a parent company to Joy. May decide not to prepare what? Group account, provided the owners and those entitled to vote are in agreement. So you may choose not to prepare group account because you too, you are also a subsidiary to another company. We get that point. And the second exemption is if the parent company's debts or equity instruments are not being traded in the public market or in the stock exchange market. So once their debts or equity instruments are not traded in the public market, you may choose not to prepare group accounts. Then third one, if they did not file, neither are they in the process of filing their financial statements with the Security Commission or other regulatory organization. Then lastly, their ultimate or intermediate companies have already prepared consolidated financial statements that comply with the principle of IFRS. So all these exemptions, all these are the exemptions to the use of preparing accounts if you are a parent company. But if otherwise, there is no excuse. Provided you have control, you must prepare group account. All right. Now, separate financial statement, IS 27. Now, if an entity is exempted from preparing group accounts, that entity is required or is mandated to prepare separate financial statements following the principle of IS 27. If you are following the principle of IS 27, how do you go about preparing single financial or separate financial statements? IS 27 says that a parent company should measure their investment in subsidiaries, investment in joint venture, and investment in associates either at cost or at fair value in line with IFRS 9, or using the words equity method in line with IS 28. What does that mean? It means that if you are a parent company and you are not preparing group accounts, provided you have investment in subsidiaries, that investment in subsidiaries will be accounted for at cost. If you have investment in joint ventures or in associates, it will be accounted for using the words equity method of IS 28. We'll get there. And if it's not a simple investment, you account for it using the words principle of IFRS 9, financial instruments. So we'll get to the equity method and to the simple investments under IFRS 9. So that's what IS 27 is saying. As simple as that. So we'll look at it in total or in-depthly later on. Olumide.
Okay. Please, trying to be clear on the exemptions from preparing group accounts. The last point, it says that the ultimate parent publishes consolidated financial statement that complies with IFRS. So if it publishes its account in a way that complies with IFRS, it can choose not to prepare a group account. So that IFRS is the way it is published. Is it published in a group account format, or trying to understand why it's like that?
Okay, yes. When they say comply with IFRS, means that IFRS is IFRS 1, IAS 1, IAS 2, IFRS 5. All those standards are the compilation of IFRS, including IFRS what? IFRS 10 and 3. So it means that this ultimate parent company has prepared group account in line with IFRS 10, IFRS 3. That's what it means. So they only just said in line with IFRS, because if you are preparing your group account, there is already a financial statement that you are using to prepare the group account. No be so? The financial statement of the parent company and the financial statement of the subsidiary. And this financial statement, before you can prepare it, you prepare it in line with other IFRS standard. So that's what it means, that they prepare group accounts in line with IFRS. So simply put, in line with IFRS 10 and IFRS 3. Do you understand, Olumide?
Yes, thank you.
Welcome. All right, so now, before there is effective consolidation, there are rules that must be in place for us to have effective consolidation process. And the first thing is that there must be uniformity of accounting policies. So we all understand that accounting policies are those rules, guidelines, regulations, principles that an entity apply in what? In the preparation of their financial statements. Before you can have effective consolidation, the accounting policies of the parent company must be the same with that of the what? Subsidiary company. It must be the same. In a situation where there are variances in accounting policies, then there must be adjustments that should be made before consolidation can take place. So they must have the same accounting policy. The other one is that they must have similar or common reporting dates, meaning that the reporting end of the parent company must be the same as that of the subsidiary company. If it is not the same, then the subsidiary company should prepare a financial statement that has a similar reporting date as the parent company's reporting period. And if it is impossible or impracticable to prepare a financial statement that have similar dates, then the financial statement of the subsidiary can be used like that, provided the difference is in date, in reporting date, is no more than 3 months, provided it's not more than 3 months. If it's more than 3 months, then there is a need for what? For necessary and major adjustments that needs to be made to meet up for that what? Gap in what? In reporting date. Then the third one, the fourth one, there must be a date of inclusion of the subsidiary, which is the date whereby the parent company acquires control. So the date of inclusion is the date whereby the parent company acquires the what? The subsidiary. So from the date a subsidiary is being acquired, then you start including that subsidiary in your what? In your group financial statement. And the date you lost control, which is the date of exclusion of the subsidiary, is the date you choose to stop including the what? The subsidiary as part of your what? Of your group account. All right. Now, there are procedures we need to follow when preparing our consolidated financial position. So we are starting with what? Consolidated statement of financial position. Remember, we said we have group statement of financial position, group statement of profit or loss. We have group statement of changes in equity, and we have group cash flow. So the one that is more complex that we need to pay attention more is what? Group financial position. That's what we are starting with. And now they are laid down procedures. It's not just that we add the assets, because assets, liabilities, and equity is the element that is used to prepare our statement of financial position. So all these 3 elements are not just to be added together in the process of group accounts. Remember I said that you add the assets of the parent company together, you add the asset of the liabilities of the parent company together with that of the subsidiaries. The assets you add it together of that of the subsidiary as well. But for the equity, we don't add it together. It's not just adding the both assets, it's not just adding the asset of the parent company with that of the subsidiary alone. It goes beyond that. In view of this, IFRS 10 gives us the procedures that we must follow in preparing our group accounts. And the first one is that we must add like items of assets and liabilities together. So what we are permitted to add together is what? Is only the assets and liabilities. They now also tell us that the other procedures is that they need to account separately non-controlling interest, and also the what? The equity of the what? Of the subsidiary, which is what? The net asset. We do not consolidate the equity component of the what? Subsidiary. We only factor that in when calculating our net asset of the subsidiary. And the purpose of this is to determine post-acquisition profits of the subsidiary. We understand that better later. But let me take that statement again. We do not consolidate the equity component of the subsidiary directly, but rather we only consider it for the purpose of calculating the net asset of the subsidiary. And the sole purpose or the sole objective of the net asset of the subsidiary is to determine post-acquisition profits. That is what? That is available for sharing between the parent company and the NCI. When we get to that part, we'll understand better. So now they tell us that we need to account for non-controlling interest and what? Net asset. And also what they also address is that how do we account for goodwill in the what? In the subsidiary. So these are the procedures that IFRS 10 and 3 gives down. So these are the process that we need to follow to achieve that. These are listed here. Before I proceed, Stella, you have a question for me?
Yes, sir. Can you please come again on the equity part? I am not getting it, sir.
You understand better later on. That's why I said you understand later on. We'll get there, you understand it, don't worry. Stella, please hold on. Because if I start, you won't understand it. So we'll still get there. Okay, so these are the procedures we need to follow when preparing consolidated statement of financial position. They are step-by-step procedures. This is a comprehensive one, but I'll break it down. The one we use for the purpose of this exam, I'll break it down. But let's go with this first. The first thing is that we need to determine the what? The percentage holding of the parent company in what? In the subsidiary. So what is the percentage holding of the parent company in that what? In that group, in that subsidiary, in the group structure?
Sorry, sir, please. I can't see your screen if you are showing anything. I don't know if it's from my hand or the network generally.
I can see my screen.
It's from your hand. We can see the screen.
I had the same problem before. So just log out and log in, you will see it.
So quickly do that. Quickly, if you can't still see it now, quickly log out and log in, please. Okay, so I proceed. The first thing is that we need to determine the percentage holding. Miriam and I think Bisola, the class rep or the class governor, please also draw my attention quickly whenever my screen is not coming up or whenever my mic is mute, because sometimes it goes or it's off by itself automatically. So just quickly call my attention so I can know. Thank you. So we need to determine. Okay, sir. All right, thank you so much. We need to determine the percentage holding of the parent company. And simply put, the percentage holding is what? Is the equity shares that the parent company acquired in the what subsidiary company, which is the above 50% that we're talking about, that guarantees them what? Control. So that's the percentage holding. Is it 50%? Is it 60%, 70%, or 80% as the case may be? Now, sometimes the percentage holding will not be directly given. It will not be directly given. In a circumstance or in a situation where the percentage holding is not directly given, how do we calculate it? It is calculated by saying, although it's in the material, but let me bring it out. So the percentage holding is calculated by saying the total number of shares acquired by the parent company, over the total number of the subsidiary shares multiplied by 100 over 1 is in the material. So meaning that if the examiner did not give you the percentage holding of the parent company, you can calculate it. Now, let's use this as a case study. I believe you can see the question, the material on my screen. So, the additional information says that our PLC acquired what? 15 million ordinary shares in what? In LEPA Limited in January 2013 for 25 million when the retained earnings and blah blah blah. So we are not concerned about that. The question is, we want to determine the percentage holding of our PLC in what? In LEPA Limited. And we said that to calculate the percentage holding, we say that the total number of shares acquired by the parent company. In this case, what is the total number of shares acquired by the parent company?
50 million.
Shares.
50 million ordinary shares. What is the total number of what? Total number of the subsidiary shares. What is the total number of subsidiary shares? So they will not tell you, most cases they will not tell you the total number of subsidiary shares. What you do is come to the financial statement. This is the financial statement. You check the equity components, the equity component aspect. We can see ordinary share capital of what? Of 1 naira each. We see LEPA Limited. This LEPA Limited have 25 million naira ordinary shares. Now, let's not mistake value for what? For units of the shares. Because most people do make that mistake. This 25 million is what? Is the value of the shares. Because we see it here, quoted in thousand. Is the value. But they say that each of the shares worth what? 1 naira each. To determine the total ordinary shares of the subsidiary, what do? You do the value divided by the what? The naira per, the value per 1 per unit. You get that? So you now say 25 million divided by what? By 1 naira. So that will give us how much? So that will give us 25 million shares. Don't be so?
60%.
60%.
So when you multiply by 100,
60%.
it will give us what? 60%.
60%.
So that's how to determine the percentage holding. So this is the percentage holding. Does everyone understand this? Yes, ma'am.
No, sir.
No, sir.
Someone is saying something. Please, if you want to speak, just raise up your hand so I can. Because I can't. What's your name, please? Okay, please, you can speak.
Yeah, please, I don't understand the solution in this, sir.
Okay. Eileen, you don't understand as well.
Yes, sir.
All right. I believe is the total number of shares you don't understand. Now we know that shares are usually issued in what? In units. They are usually issued in units to be converted to what? To value. To be converted to value. Now they are saying that this company has 25 million shares, not no, rather 25 million worth of shares in value. Or before I even explain that, let's say I have bags. I have 20 bags, and each of the bags cost 5 naira per bag. Please, what is the worth of my bag? 100 naira, right? Hello?
Yes, sir.
Are we? So the
Yes,
total
sir.
worth of my bag is what? 100 naira. But each bag costs what? 5 naira per bag. So if I have to get the total number of bags and each bag costs 5 naira, what do I do? The total number of bags is simply the total worth of the bags, 100 naira, divided by the cost of one bag, 5 naira. And that will give us what? 20 bags. The same thing applies to this situation. The total worth of the shares, the worth of the shares is what? 25 million shares. And each cost per share is what? 1 naira. Because it was stated in the question that ordinary share capital, they now say 1 naira each. They always give you the price per share, the market price, the nominal price per share of the shares. So they'll give you like this. They now give you the total worth of the shares in value. Are we following? So now to now get the total number of shares, follow the same thing. You divide the total worth of the shares, which is 25 million, with what? With the amount per share, 1 naira. And that will give us what? 25 million shares in units now. 25 million shares. And that's how we arrive at this 25 million here. Do we understand? Stella, answer up.
Yes, sir.
Yes, so my question is this also the same thing as earnings per share?
No, that is another ball game.
Okay,
It's different.
sir.
All right. So I believe everyone understand this now, right?
Yes, sir.
Okay, good. Ayomiku, do you understand or do you have a separate question?
It's relating to this. Although my question is, so in the statement of financial position, we are given the total worth of shares, and then
Yes.
it will be told that this is the price per share.
Exactly.
So dividing the total value of the shares by the amount of the value of each share should give us how many shares they have.
Exactly.
Okay.
Very
I
correct.
think it's clear.
Fantastic. So if you guys understand that, I want everybody to attempt this one now. So let's attempt it and give me the percentage holding of the parent company in additional information 3. Additional information 3. So let's do the same way I did it. So let me just write beside it the total value of the shares and the worth of the shares. So for this is Opeke 18,750. 18,750. So let me just put that in notes here. Worth of the shares 18,750. The price per share 1 naira. So let's calculate this percentage holding in 1 minute. In 1 minute. Oh yeah, everybody.
percent, sir.
30%.
30%.
Maybe coming down small now.
Thirty percent.
Okay, let's 30%.
The answer is 30%.
Okay, everybody agree 30%, right?
Yes, sir.
Yes, yes, sir.
Yes, sir.
Sir, you're muted. We can't hear you.
Now,
He's not muted. No, he's not muted. We
Please,
can
I
hear
didn't
him.
get 30%.
what did you get?
45.
45%. Who else got
Hello,
45%?
sir.
Yes, I'm with you.
Hello, sir.
I'm with
Hello,
you, please.
sir. You have to come back on. Hello, sir. Please, you need to come back on how you arrived at the first illustration. As at that time, I was struggling with my network, so I didn't even see what you are doing.
Oh, I'm so sorry, sir. I can't come back, please, because of time. Please, it may watch the video. So, but if you can see my screen, this is how I got it. I even got the formula: total number of shares acquired by parent company over the total number of subsidiary shares times 100/1. So someone said she got 45%. So let's do it together. Just do it together because of time. But PSC acquired 5.625 million ordinary shares in Okpeke Limited on so date for so amount. We are not concerned about the amount, we are only concerned about the percentage holding. And we said the percentage holding is determined by the what? The total number of shares acquired by the parent company, which is 5.625 million shares, over the total number of the subsidiary shares. They give us the value of the subsidiary shares to be what? 18,750,000, right? Where is it? 18,750,000.
Yes, sir.
Which is 18.750 million divided by what? By 1 million ordinary, 1 naira ordinary shares times 100. 18.750, we have 5.625 million over 18.750. If you divide this, you still have at the same thing times 100. This should give us what? 30%. Please, do you understand this? Okay,
Hello,
good.
sir.
Yes,
Where do we get the 18.75 per million? Where is
it's
it
on
in
the
the first
financial
place?
statement. It's on the financial statement. This is it.
Yeah.
The ordinary share. Okay, so back to the procedures. So the second thing, the first thing is determine the percentage holding, as we have done. The third thing is to what? Is to draw the group structure. Draw the group structure. Nothing serious. The group structure is to determine if we have a
I have question.
relationship. If you have a question, please put up your hand and I will attend to your question. So the group structure is simply when a parent company acquires a subsidiary company, so 80%, then there is existence of NCI, put NCI 20%, that is 100% minus 80%. So this is an example of a group structure. It can be a structure whereby the parent company has two subsidiaries. So we have B and C, 70%, 50%. A, B and C, 57%, 25%. So all these are just group structure. They will get it. So this is how our group structure usually is. Sometimes ICAN can draw theirs like this and saying something like this. Let's say 60%, NCI 40%, whichever way. That's how our group structure is to show us the composition of the group. Alright, then the third thing is that we need to make adjustments. So perform double entry to record any individual company adjustment. So we need to carry out an adjustment that is necessary because I think I did not add that. Yeah, I said the procedures. After we calculate goodwill, we also need to what? To do adjustments by eliminating intergroup balances. We eliminate intergroup balances in our what? In our group account and any intercompany what? Transactions that may occur in the business, because from the group perspective, the parent company and the subsidiary are regarded as one. So they cannot make profit from each other, neither can they incur expenses on each other, because they are seen as what? One. So any intergroup transactions must be eliminated in full. So that's the third one. We need to carry out all those adjustments to ensure all those things are being done. Jane, let's not ask much question again. It's almost 5. The next thing is that we'll now calculate the adjusted retained earnings of the what? Of the subsidiary. The adjusted retained earnings of the subsidiary what? We calculated as a date of what? Consolidation. We'll see all those things later on. We need to calculate the net assets. So you see where I said this net asset will still explain it. Net asset of the subsidiary at acquisition date and at the reporting date, or as at what? Consolidation date. So, and the purpose of this net asset is to determine the what? The capital reserve, or rather the post acquisition profits of the what? Of the subsidiary. That is, as at when they acquired them and to the time they are preparing consolidation, what profit have they made, or have they incurred loss? And those profits or loss will be allocated between the parent company and the NCI based on their percentage holding. We'll look at all this later on. Then the next thing, we'll calculate goodwill. Calculate non-controlling interest as at the reporting date. Then we calculate what? The retained earnings of the parent company itself. Then finally we have prepare a consolidated account. But for the purpose of this class, the process we are following is this. The first thing is that we need to draw the group structure. So this is the first assignment I'm giving us. I want to ask us and be able to tell me this. So after we've drawn the group structure, the next is to prepare the what? To calculate the net assets, which is also referred to as capital and reserve. So we also call it capital and reserve of the what? The subsidiary. So this is the next thing we need to do, calculate the capital and reserve of the subsidiary. The third thing is that we calculate goodwill. All this process is what you should go and know now. That's the first assignment. Computation of goodwill. Next is what? Computation of non-controlling interest. 15 is what? Computation of consolidated retained earnings, CRE. Consolidated retained earnings. Then we can now what? Prepare our book account. So this is the process we'll be following in the course of the class. So all these procedures, please go and know it. Go and know it. So adjustments will come in. We'll do adjustments. But let me put, I don't want to put, so the first thing I usually do is, I won't like doing adjustment first. But for the purpose of ICAN exam, this is the process you follow. To now make it effective for you guys or efficient, so that when you are in the exam or so that it's more easier, the first thing you can do is to what? Go for adjustments. So all from 1 to 6 is what ICAN is interested in. So this adjustment is needed to do 1 to 6. They are needed. So I usually start from adjustments before I now start the good structure. So all these adjustments, I will now be slotting it, so putting them in where necessary in each of this 1 to 6. Is that understood? So that's where we'll be stopping for today. That's the first assignment, scanning the procedures, and also know these key terms. DOA, I'll be saying DOA often, DOC, PC, NCI, that's what we'll be using often. So we need to understand the full meaning of those acronyms. Is that fine? So we'll be stopping here for today. So let me just take a few questions within the next 5 minutes before the next class. Meyeku, what's your question?
Okay, good evening. My question is, if I want to get the number of the value of shares, is it the number of shares in the additional statement or the one from the financial statement that I'm going to use the calculation?
It's the one in the financial statements. But you must take note that what you are interested in is what you should first check out for. We are interested in the total number of subsidiary shares. So that's why you'll be looking for the information that relates to the subsidiary. You get?
Okay, sir. Thank you.
You're welcome. Oluwaseyi. Oluwaseyi.
Hello. Yes. Yes, thank you. Net assets. I want to ask a question relating to net assets. You will see in some textbooks or some write-ups that when a company is acquiring another company, is acquiring the net assets of that company.
Yes, sir.
But during your explanation, you mentioned that that company is actually acquiring the capital or the shares of that company. You never mentioned anything relating to reserve. Can you clarify that?
Okay, and that, if you can look at my screen, sir, I said net assets. Can I put capital and reserve? Have you seen it? Capital and reserve.
Yes.
So, and when we come to next class, when we are looking on the calculation of goodwill, we will see where those net assets and capital reserve comes in place. So from there you understand better when we are looking at IFRS 3 business combination. Do you get, sir? You understand that, sir? Okay. sorry, your name Adaza. Please pardon me if I don't pronounce it well. Adaza, you have a question?
Yes, sir. So I've been checking through the
Material.
WhatsApp and the. So I'm looking for that question you've been using as illustration. If you can have it.
Okay, because as illustration is not in the book material and we don't need it now. I will just pop up, I bring out random past question, November 2020 diet.
Okay, thank you.
November 2020 diet, question 1. So in case you need it for study purpose.
Okay.
All right, ladies and
Thank you,
gentlemen, boys and girls, mommies and daddies, I believe we have a brief and a glimpse understanding of our group account so far. And from our next class, we'll be looking at the calculation aspects in-depthly. So broaden our understanding of group account. Hello.
Sir.
Yes,
Yes,
sir.
sir. Please, can you just explain this third point in the procedures, the performance and perform double entry to record any individual company adjustment that might be necessary? Can you just explain it again, please?
Okay, I explained that. I said we need adjustment to cancel out intercompany balance. I wrote it here, intergroup balances, because the parent company and the subsidiary definitely have some business transactions with each other. So all those intergroup balances should be eliminated, because as group account is concerned, as far as group account is concerned, both the parent company and the subsidiary are one. And as a single entity, you can't say you want to incur expenses on yourself. You cannot also say you want to what? Incur income on yourself. It's not possible. So from group perspective, they are one. But from individual perspective, there are two entities, different entities. Upon consolidation, any balances they are owing each other, any expenses they are expected to incur on each other will be eliminated. So it is that point two that will help us to do that, which is the adjustment I was referring to then, which is the adjustment I was referring to in this place, the adjustment.
Okay, sir.
Do you get it, sir?
Thanks, sir. Yes, sir. Thanks, sir.
You're welcome. Right, sir. Welcome, sir. Ellen.
Okay, sir, please can you go back to that your scenario where we have like 4 companies, A, B, C, and D?
On the notes, right?
Yes, on the notes.
Yeah.
Yes, under the members of the board. Yes. No. Okay, yeah, yes. These are number 756. Please, can you like throw more light on that?
Whoa, you can watch the video. I already gave that. For instance, if entity A have 7 members of the board, have 7 members, and B has 5 members, this one have 2 members, and this one have 6 members. I'm not saying, although I was trying to explain one point there where control exists and you do not acquire up to half of the voting rights. That's the point I was explaining. So although this guy have 40%, and also he does not have half of the members of the board, because the total number of the board is 20. Half is expected to be 10, but he did not have up to half of the board. But however, he still have control because he has more members put together as compared to what? To other entities. So in that case, he has control. So that's what I was trying to explain in this case. Do you get it now, ma'am?
Thank you, sir.
All right, thank you everyone for your time. I believe we understand up to an extent what it is. Please, any further questions should be sent to the group. The material will be sent immediately after the class. It's 5 o'clock already. There's another class that has started, so that others that are attending this class can join. So thank you all for your time. Do enjoy the rest of your day.
Thank you,
Bye.
sir.
you, sir. Thank you very much, sir.
Thank you.